Welcome to ClearlySo's sixth webinar on impact investment funds. Real estate is the theme this time, real estate rupture and recovery, risks and returns. I'm really delighted to have three outstanding panelists with us today to talk about this, with three very different perspectives. We have Shamez Alibhai from Man Group, we have Juan from Patron Capital, and we have Arnie Sriskandarajah from Roundhill Ventures. What I will do is let them introduce themselves, then I'll briefly introduce myself, and then we'll get right into it. Shamez, we'll take it in alphabetical order by surname, so we'll start with you.
Thank you very much, Rod. And thanks for everyone for joining today. My name is Shamez Alibhai. I'm a managing director at Man Group, and I'm responsible for the community housing fund at Man. And let me give you just a very brief summary of what that's about. Our view is that the traditional development model, whether it's home builders, build to rent, etc., have failed the housing market. So if you are the median household in this country, on average, you cannot afford to rent or live in the areas that you work, especially in areas of high economic growth. And so we've launched an impact strategy to really tackle that problem of how do we make housing inclusive for the bottom 65% of households in the UK.
Thank you, Shamez. Juan, over to you.
Thanks, Rod. Hi, everyone. I'm Juan. I'm from Patron Capital. I'm the vice president in the investment team. Patron Capital is a real estate private equity fund based in London. And over the last 20 years, we have been successfully raised a series fund and focusing on investing in real estate directly, including offices, retail spaces, or operational real estate sector, like, for example, healthcare. And the third bucket is more like complex transactions, including equity release business or mortgage business. In parallel, we have been involved a lot in charity initiatives, including three key areas. First one is Armed Force. We are the largest sponsor for the Royal Marine. And the second bit is about educational initiative. Particularly our founding partner, founding manager, Keith Bressler, he's the chair on the Prince Teaching Institute, which is helping a lot of state school teachers to empower their teaching skills and back to the school. And the last bit is infrastructure, which is quite related to what we are trying to work right now, particularly myself, which is trying to leveraging our social enterprise, social investment focus together with our real estate expertise. So over the last 1 year, we've been actively looking at investment or combine our real estate expertise into the housing sector. So we are trying to work on more housing for vulnerable women, particularly in this regard. We'll discuss that more in detail later in the stage. And thanks, Rod and the team for this webinar. I'm very excited for it.
Great, thank you very much, Juan. And over to you, Arnie.
Hi, everyone. Arnie Sriskandarajah here, Managing Director of Roundhill Ventures, which is a prop tech investment firm founded about 3.5 years ago. We're backed by a well-known real estate private equity firm called Roundhill Capital. And over the last few years, we've been kind of pioneers in prop tech strategy in Europe. We were early to the market in the digital transformation of our sector, which has been a laggard compared to all the other main asset classes globally. And over the last 3-4 years, we've invested directly into 15 companies, really disrupting everything from how consumers access and consume real estate, how we look at data, breaking down into silos, and also looking at resources and how do we actually optimize resource allocation within our sector. And when we think about impact from our perspective, every theme and every company that we look at has a strong impact element to it. And I think that's a relatively novel approach to venture investing.
Arnie, thanks very much. And as I said at the outset, we have three panelists with some very diverse expertise, and we're going to plow right into that. Let me start by asking just a general question. I mean, obviously, there's so much going on in the markets right now, and we'll take this in the same order. Question's really just, can you summarize your view on the property market, commercial and residential, and within commercial, office and retail? So let's start with you, Shamez, and Juan, then Arnie.
Thanks, Rod. Look, I think COVID has really upended everything that we know about real estate and where we thought value was in real estate. So, what are the easy targets? Well, retail has been an easy target in COVID, and we've seen, shopping center valuations, retail valuations fall by 40, 50, 60%, and this is for kit that was bought 3 years ago. So you've had this massive destruction of capital values in and around retail shopping centers, etc., even high streets. So I think that's the obvious victim. Then there's the whole question mark is what happens around office. And no matter what happens around office, I think the view that office, London, Berlin, Madrid, Frankfurt office can now be looked at as a core asset class in and of itself, i.e. an asset class that preserves value, delivers a steady income. I think that assumption has been upended. I think we're going to see a model now where office is going to look a lot more operational, where it's being used as an entertainment or a gathering or as a brainstorming center rather than rows of static desks that have always been there. We're going to see leases shorten a lot more in office space because employers won't know what the working patterns of the future are going to be. And I think the idea of locking into a 10 or 15-year office lease after this recent bout of COVID is going to scare quite a bit of CFOs. We're going to see less dense offices than we have in the past. So I think that is a very interesting thing. I could easily see office values fall by 20 to 30% from where we are today. It hasn't happened because it's a very sticky friction market. There's no sellers. You wouldn't want to sell into this space. But when that breaks, I think you can easily break down 20% through a combination of yield widening, increased CapEx costs, shorter lease terms, etc.
Resi?
I think Resi has proved to be the surprise in all of this. We've seen Resi single family in the US, multifamily in the US has been around for much longer, but single family in the US, multifamily in Europe perform very well. And I think, again, you're going to have a bit of a bifurcation. You saw a lot of very expensive Resi in central London, 1 bedroom, 2 bedroom apartments, even 3 bedroom family style apartments in London. I think that flatted, dense, urban solution is wrong. I don't think that it's going to work in the world going forward. I think what will come out looking very good is that single family rental stuff, the type of product where a family is going to move in, they're going to put their kids through school, and they're going to be there for 10 years as their kids go through school. And I can see, and we're starting to see that very much now, people actually rolling out of commercial core and using Resi core, the single family type of product, as an alternative to commercial core.
Thank you. Juan, what would you like to add to that?
Yeah, I think Shamez's view is very helpful, and I just want to add a bit more in terms of perhaps more insight from our investment angle or from Patron perspective, what we've seen over the last few months and what we think could be happening over next few months. So I think start with office as again, I think the office still as being considered as we consider it still as kind of demanded space, although over the last few months, people challenge around whether the office is still needed or how it should be evolved over last few years since COVID. But general view is we think the prime location offices still will stay very strongly demanded in terms of the yield and in terms of the investors' demand looking for those type of assets. On the other hand, perhaps in comparison, the suburb office, for example, business park, would be perhaps potentially more risk around it, need a bit more work, understanding underlying potential demand post-COVID and the vacancy level. So offices is up and down. It really depends on the location and macro demand. And in terms of logistics, it keeps strong demand. And before COVID, it's always lack of supply and strong demand due to the e-commerce. And this trend, we believe, will be continue, and it will be keep going, and this asset class is really where most investors are going for. Residential, I agree, it's very strong sector, and during the COVID, relatively resilient to the impact because it's based on the demand from the people, especially the affordable housing sector, build-to-rent sector, where although the transactions was kind of quiet early years, but we expect it's coming up. And we've seen a lot of transactions lately lining up as well. Retail and hospitality sector, unfortunately, the most destroyed or impacted over the last few months. And especially retail, which already been impacted significantly before the COVID. So depending on the nature of the retail, fashion led or food led, it will be driven to the different direction of the COVID. That's what we think. Hospitality sector, again, has been impacted significantly. And we hope that once travel restriction relieved, this sector will bounce back soon.
Thank you. Arnie, a lot of ground covered. Any views where you're different?
Yeah, maybe from a different standpoint, because I spend most of my time looking at technology and new business models in the space versus investing in the hard assets. So what we found certainly over the last 6-9 months was, I guess, COVID has just been an incredible catalyst for the industry. I call it incredible. Some might use a different adjective for it. But when we look at retail, when we look at office, I think technology has advanced to the point at which communication is fantastic, right? We're having a Zoom call today, so people interacting with each other, having that. All right, it's digital, but it's still face-to-face conversation is continuing, even though we're not physically in the same space. And if we, Juan touched on e-commerce, we're doing a lot of our purchasing online, and obviously COVID's accelerated it from low double digits to quite high double digits now. So we've seen this as an accelerant to kind of adopt technology through more of the masses. I think hospitality, I'm not. It's a different case. Our view is, it's going to bounce back to a certain extent because technology doesn't have the same impact on it as it does on office and retail. And then from a residential perspective, and I'm going to touch on something Shamez just mentioned earlier, is throughout all of these asset classes where we're spending time, the operational costs are going to go up significantly because the end user is going to be more demanding of what they expect from the experience in these spaces, right? So even folks in the multifamily sector you're going to start seeing new operating companies come in who are able to offer additional services for the end user. It may be lighter than an office where you've got to add a huge amount of value to ensure people have great experiences when they're in the office. You need to get them there, and you need to be in a position that they feel like they're adding value to their day by being there in person. So I think offices, once again, is going to be an increase in OpEx because you need to create that atmosphere. And do you do that with people? Do you do that with technology? Clearly, my view is technology is going to be the differentiating factor in all of these experiences and allowing you to interact with your physical space better. So in short, I think COVID has been an accelerant in most of the real estate sectors in terms of what we would have seen in 3 to 5 years. We're seeing in the space of 6 to 9 months, and I'm guessing over the next 6 to 12 months we'll see some of the repercussions on price, as Shamez alluded to.
Thank you for that. We really have seen COVID be quite an accelerant to trends that were going on for some time. We're going to go into technology in a little bit, but first, just from an impact investing perspective, and we'll start with you on this one, Arnie. This was one of the first big sectors in the impact investing space. Do you have a sense as to why property has been one of the initial focal points for UK and also European and international impact investors? What's your sense, and do you think that will continue?
I think if we zoom out, if we look at it from pure asset allocation perspective, real estate is by far the largest, right? I think 2 times the other financial sectors. So I think, first of all, it's a very tangible physical asset to allocate capital to. In an era over the last, say, 7 to 8 years where there's been a shift towards different ways to describe it, let's call it impact investing for now, and people wanted to see tangible evidence that their capital was having an impact, positive impact on whatever criteria that they were looking for. And I think with real estate, you without having strict criteria or a method of measuring, you can have a feel for whether there is a change. And so I think biggest asset class, not really sure what impact really means. So people want to be able to have a physical want something in the physical world, and they want to see something they can actually touch and feel and see the differences, changing people's lives or making people have access to homes better, giving them the opportunity for social mobility. And that's what real estate gives access to from an impact perspective. And I think that's probably why, if we look through impact allocations, I think probably up to about 15% of the capital that's been allocated to impact investing globally has gone to real estate. And I think that's going to accelerate over time. And I'm sure products like affordable housing that Shamez is working on is going to be probably one of the key buckets that capital is going to be allocated to.
Great, thank you. Well, Shamez, he's given you the lead in, so I'll go to you next. And also, as some of the audience will know, you were one of the first big UK impact funds that you were managing. What's your perspective on this question?
I think we have to remember where we started. 4 years ago, when I marketed our first impact fund, people didn't even know what the word meant, right? What's an impact fund? How much return am I going to give up as a fiduciary to allocate to your fund? Maybe this belongs better in my charitable bucket rather than my investment bucket. These were the kind of prejudices or concerns even that people had when they started talking about impact investing. I think Arnie hit it square on the head when he said real estate was this thing that people was tangible. They could see how you could use this property to have a very specific, tangible, direct effect on people's lives. And that was by just very simply lowering the rent levels or making the property affordable or addressing a constituency that may not have had enough housing. Juan's point about women's shelters or learning disability. But I think the other really important point to that, Rod, was that there was alternative use value. People knew that if they got the thesis wrong, there was some underlying embedded value in that asset class. And I think that was very different from, for example, from private equity or from venture, where people had to say, well, this is new, this is different. If I get this call wrong, what am I left with? I'm left with a bagel. Versus if you look at housing, at least you're left with the housing stock at the end of the day. So I think there was that risk mitigation element of it that played very well with investors. And then I think the other bit that didn't get classified as impact, but probably could have, should have, was just the environmental agenda, the green solar, wind, renewable energies. It's interesting that didn't get brought up into impact as having environmental impact. There seems to be this discussion that impact, or often impact, is always looked at as social impact as opposed to environmental impact, because environmental impact goes into ESG, and it's like these weird buckets. But if you look at private equity renewables, that's a huge asset class. So I think that if we include that, you have real estate, which is great as an asset class within impact, and we've had a lot of really great stuff that's been done in the renewable space around impact as well.
Shamez, thank you for that. We'll go to Juan. What's your perspective on why people kind of fancy real estate as their route into impact?
Yeah, I think it's by nature, like 90% of people's daily life are spent in real estate. So if you want to really improve people's life or improve the social awareness or like social feeling, real estate is the first touch. And I would say, like, at the first stage of real estate, whether real estate is really the key bucket for the social impact, I wouldn't say so, because I think real estate, because it's capital intensive, so in terms of size, people would be more noticeable to see the sizable fund for social impact in housing or social impact in real estate. But I believe in parallel, there are a lot of social impact investments in, for example, in renewable energy, technology related. So I think in terms of size, perhaps real estate is more catching the eye, but I believe it's in parallel. There are different type of social impact investments on the road. But I would say that the demand for the social impact investments in the real estate would be the key trend still over the next few years, as long as I believe, because there is still significant shortage in terms of the right accommodation for the right people, and especially for the vulnerable group, there are significant shortage of the accommodation. So in terms of providing the right accommodation, that would be the key.
That's very interesting. Juan, let me stick with you for a second, because you raised this question, and it's something Shamez touched on as well, which is is it environmental versus social, and how that's been changing over the past few years. Do you have a sense for where the thrust of investor interest is to deliver impact through real estate, and where you suspect the most momentum is right now?
Yeah, I would say from the ESG perspective, ESG over the last few years has been significantly integrated to the mainstream investors. And so the environmental element has been emphasized significantly, particularly among the ESG elements. And while time passing, I believe the social element will be more and more being focused, because environmental in parallel in comparison with social is more challengeable to address because it's more related with community demand, and also it's also challenge to be measured compared with environmental. But given the ESG has been building a very solid foundation in terms of in the mainstream investors trend, we think the social it will be the natural next step for more and more investors looking forward in the long term.
Thanks for that. So you think it's more the social side. Arnie, I was looking at some of your portfolio companies, and I would say that's probably also true. Do you think that's the case, that people are now looking more for the social impact and the environmental stuff as a given?
Yeah, I think in order of E, S, and G, I think that's the order in which the market has reacted to that acronym, right? So we've spent a lot of time focusing on environmental, and of course, with a huge amount of top-down pressure now from a climate perspective, E's has a lot of momentum behind it, and has been integrated into both harder asset investment, and there's also technology investing, right? My fellow panelists have touched on renewables and have touched on technology developments, and they've really focused on the E piece. And I think the social element is, probably lagging by 3 or 4 years from just generally seeing the interest both on the capital side, but also opportunities for us to invest into products that are available that actually has a focus on the S element, and governance we can come on to at a later date. But I think there's also a clear connection between them all. It's not environmental impact has a positive impact on social and governance, right? It's all interconnected, and I think sometimes people want to decouple them, and there's a lot of groups that we sometimes see trying to pitch us tech companies which focus on particular UN sustainable goals, and it's not one-to-one, right? It's many to one. So a service or a product can help have an impact across a number of these goals, and it's not always environmental, it's not always social, sometimes it's a combination of both. But coming back to the point you were making, yeah, environmental has a head start. That's leading in the mainstream of investments. Social will be there very shortly, and then governance is going to follow suit quite quickly. So I think it's accelerating. I think within the next 3 to 5 years, I don't think we'll be seeing this as a separate category, right? It's going to be a social norm or an investment norm. Great.
Thanks for that. So if it would have been the GSE guidelines, then we would have had it in the other way. I'm kidding. Shamez, should we move on to the next question? So I know you were the first one to raise the environmental point, but maybe the next question as well, which is, what sorts of social impacts do you think people are now starting to focus on? I mean, obviously, all builders are now trying to do things in a more environmentally sustainable way. But with regard to the social side, there are so many different directions that people can go in order to achieve impact through property. What's your view?
There's 2 dimensions there. One is scale and depth of impact. So there are some very difficult problems around housing that exist today. Homelessness clearly is a huge challenge. Women's shelters that, again, that Juan is working on, huge challenge. And so you have these very small groups where the level of impact is very deep. It's very, very deep. And, I'd like to see, something in healthcare. I'd like to see an impact Four Seasons or Southern Cross. The private sector has done a horrible job in elderly care, so where's the impact fund doing elderly care? So I think there's these spaces which have a high level of challenges. It's a very challenged population group that you're working with, whether it's the elderly, the sick, homelessness. And then the issue I think is really around depth of deployment. How much capital can you deploy in that space? And what's the pace of that deployment? So it's not just depth, but how shallow, what's the ramp up to that space? And I think that's a challenge that investors are going to have to grapple with. One of the questions I have is, does impact capital need to be everywhere? Should we be in homelessness? Should we be asking for a real estate private equity style return when dealing with homelessness? And I think that's a legitimate question. So I think that question, people will be probing that. There'll be different funds tackling different price points around that strategy. And hopefully in the areas that are most sensitive, you're going to have to deal with a lot of regulatory risk. So how do you have, regulatory risk not being offset by higher level of return? So I think there's a lot of challenges in that space, but there are definitely some people trying to tackle that. I think the other space which is where we're focused on is more around the median worker, right? The bulge of the population. If you're a teacher in Cambridgeshire or a key worker in Cambridgeshire, there's about 1 in 10 key workers in Cambridge can afford to live in and around Cambridge. Now that's a huge problem. These are people with good quality jobs, hardworking, they've had good lives, they've done exactly what everyone told them they're supposed to do, but they can't afford to live in good quality or reasonable accommodation next to their family, their loved ones, their place of work. And I think that is a really fundamental problem. And I think impact really needs to go around find these areas of market failure, right? So care homes, elderly care homes, that's a huge market failure. The private sector has done terrible in that. How can impact funds do it differently and do it better? Residential housing for the middle class, for the median class, how can we do it better? And I think when you're starting an impact fund or looking at impact, I would suggest we need to focus on those areas where there's been a clear and distinct market failure and that there's that scope to attract capital. Otherwise, you just become very niche and you're not really changing the overall narrative in a fiduciary's head around what can impact do for their portfolio.
Thanks very much for that, Shamez. I mean, we've talked now a couple of times about the issue of housing and the massive failure in that area. Juan, you're dealing with a very particular approach to housing. Maybe you want to talk a bit about that, but also in general, do you concur with Shamez that housing is an area where there is market failure? And I suppose with the demand for capital is astounding. I think Shamez, you wrote in a report in maybe it was May that we need 2.5 million homes in the next 15 years, and we need something like 240 billion to solve that. So what are your reflections on that, Juan? And also talk a little bit about particularly the subset of that market that you're addressing.
Sure, yes. So I think I cannot agree more with Shamez's point. And I think he just basically touching what's a real so-called social impact fund. Social impact is really from where the need is. You drive the social, you understand where the social demand is, then you invest. Instead of you invest and then understand the social impact on the other side. So that's effectively how we want to understand this market, and that's how we enter in this market and develop what's the right product, what's the right housing solution. So we work with Big Society Capital. They started doing the initial feasibility work and understand where's real challenge and the difficulty and the mismatch of the supply demand was. That's where the housing issue is. There's no place, or like women suffering from, like, for example, domestic abuse is a big issue, particularly during COVID, where people actually lock down with their abuser, or women suffering from homelessness, or single mom with kids whose age particularly older. And those particular issues are very challenging for them to entering the housing ladder from the local authority perspective, or access the right accommodation, refuge space from the right party provision. So because of that, we understand there is a significant issue around it. So we come from the issue and understanding. I personally have a discussion with over 100 charity partners in this field and understand what's the right accommodation they are looking for, what type of accommodation they are looking for, and understand where the demand is. And then we find the right housing solution for them. And then we come to the investment understanding, which we leverage our understanding in the market, expertise in the real estate, and to see how that could fit into the institutional type of investor in the future, and potentially with a catalytic investment at the beginning to design the model to make it viable. And I totally agree with Shamez's points in terms of scalability. That's one of the critical issues. We are not trying to by establishing one product to help one specific area's issue. We are targeting to resolve an issue for nationwide, or potentially if the model is workable, we want to duplicate to other countries, because domestic abuse issue, for example, is a global issue. That's why we want starting from one specific region, one specific issue, and then spread out to the world. So that's our understanding on this question.
Thanks for that. And before I turn to Arnie, also to carry on with this question of the housing matter, first of all, I should apologize, but in keeping with the theme, there's construction going on next door. So if it's really noisy, let's just say it's part of the mood music for this session. But let me ask you, Juan, on the specific types of products you're developing, and Shamez raised this issue of the returns available, and can we always get the returns that investors are expecting? In the sorts of products that you're just discussing, can an investor generate market returns based on the models you've come up with?
Yeah, so we start with the demand side, and we understand what do they want. They want a sustainable access to the accommodation, so long-term accessibility. Effectively, what we are trying to design is more like a dividend type of investment fund, where you actually renting to or leasing to the tenant for long-term access, and then grow over the time. Potentially, investor benefit from the capital gain from holding the property. So, in fact, we believe it's more like a market rate level of return, and plus with significantly social impact of social return. So when we evaluate this product, we evaluate from 3 dimensions. One is the risk, one is return, the third is impact. But for the first 2, we are trying to benchmarking the market level, and then with the third bucket, trying to target maximize points.
Terrific. Thank you very much for that. Arnie, over to you on the question of social housing. I know it's not the core part of the area, but you do seem to have some innovative solutions in the housing space. What's your reflection on kind of solving this massive problem in social or affordable housing in the UK and internationally?
It's a good question, and I think it really kicks off with the main point both my fellow participants made, where there's a significant mismatch, right, in terms of demand for homes and a lack of homes in the UK or more broadly in the developed world. So, one of the areas that we spent a lot of time thinking through, and especially over the last couple of years, is how do we solve for that from a technology or a new business model perspective? And one of the obvious answers I'm sure we've all heard of is modular housing. And it's not a simple case of your old-fashioned temporary housing. We're talking about good quality in the US, a bit more steel. In the UK, historically, we've had wooden structures. So we're really looking at modular housing and trying to understand what are the frameworks around that, what are the processes, and fundamentally, are there technology solutions out there that enable modular housing to be utilized for things like affordable housing, and also looking at potentials to repurpose existing sites for dwelling, for social housing, for affordable housing. We spend a great deal of time on that, and we're very close. Within our pipeline, there are a couple of tech platforms which enables modular housing to be built in a cost-effective and in timely manner. We also are a small shareholder in a business which does solutions in the modular space for social housing, temporary housing. Right, you can put these solutions up in 8 to 12 weeks, and they last for 10 to 15 years, and they have a value at the end of that life cycle that doesn't require any planning regs changes in the UK, certainly. So looking at that whole modular piece to just create more dwellings is one way, and create dwellings that are affordable, just purely based on from a financial return perspective. You can raise capital and put this product together, and it pushes out the type of returns you would expect, or an investor would expect. So that's kind of on the front end. But one of the areas that we do see a lot of things moving in, and it doesn't necessarily fit within the social housing bucket, but just in terms of financial well-being, it's a big piece for us when it comes to real estate, or within our prop tech kind of sphere. And that's how do we make it easier, more cost-effective for folks to rent or buy real estate. On the rental front, there's been some governmental changes which has reduced the burden that agencies and brokers have applied to the industry, which has been helpful. but the burdens have really been lifted by utilization of technology. So we're really thinking around what tech companies are coming in and actually are ahead of the curve, not just reacting to governmental changes, but seeing what's to come over the next few years, and taking that, a drop in 3 to 4% cost of renting a home. It's meaningful for the average renter in the UK. So I think we're looking at it from that perspective, and also looking at schemes which, shall we say, are in the private sector that mimic Help to Buy without propping up the real estate industry. So looking at interesting mechanisms that fundamentally allows the end user to access their first home, but also those are all investable products. So behind that sits capital that's looking for strong returns, and it's going to have a meaningful impact on that person who's taking out that loan or equity investment through this fund, or a debt piece out of these products. But fundamentally, they're still looking for great returns. So we don't only look at it from a mismatch from product. We're looking at repurposing product, but also allowing people to access it, whether through rental or through buying as well. And we see a number of solutions in the market. And I think the UK, especially with prop tech, has been quite ahead of the curve compared to some of our kind of continental friends in terms of building solutions in this space.
That's a great point, and I'm grateful for you in helping us see that actually the innovation can be both with regard to technology and how it can be applied, but also how we can re-engineer the basic models of ownership, rental, etc. I think that's a really interesting point. I'd like to spend quite a bit more time on technology and model rejigging, but let me turn to one question before we leave housing that one of the audience asked, Brandon Rudder. The question, and please be brief with your answers, with retail and commercial properties struggling due to COVID, is there any movement transforming said properties into affordable housing? In the US, he sees, I could see turning shopping malls and shopping centers into mini cities with a focus on affordable housing. I'm here in the city today. I see a lot of very tall buildings, and they would make some flats with great views. Any thoughts on that? We'll start with you, Shamez.
Thanks, Rod. Just before I answer that, when you come to technology, I'd like to give you our experiences on MNC and efficiency, which I think echo a lot what Arnie has said. But turning to the audience question, I guess it depends on what you mean by transforming properties, shopping centers. The building fabric of a shopping center isn't natural for housing. When we develop housing, we want housing with a dual aspect. Windows at the front, windows at the back. And why do we want that? Well, when you have a global warming situation and summers in England are going to get hotter, a great way of passive cooling your house is by having windows that open on both sides and can and allow airflow through. So I think the form of a shopping center doesn't lend itself well to like a reprofiling of that asset within the same fabric. I haven't seen anyone do that well. But what I do think, and I would agree with the panelist question, is that space is redundant now. It has no value. It is land value less demolition cost, and it takes a long time for property owners to accept that. Right? You can keep ticking over, and you've seen that in a lot of the high streets. Why are some of our high streets in such bad shape? Is because the cost of buying that property from that guy who's got Paddy Power or Betfred in it, even though it would be much better reprofiled as housing on that high street to bring some dynamism, people have a hard time accepting that their land is worth a lot less than they think it is. And I think you've seen shopping center malls drop value by 60%. Typically on a project, real estate land, depending on where you are, is anywhere from 30, let's call it on average, rule of thumb, 30% of the value of the development. So now we're getting pretty close to land value. There's a shopping center in Ashford that had a really down value. You've seen stuff in Maidstone that's a down valued. That stuff now you can start thinking about knocking some of it down, keeping a bit of the shopping center going because you still need a bit of retail, maybe moving that more experiential, as Juan was saying, that experiential retail. Having some services like Arnie was saying, where people who are living there can, have a little working space where they have a printer and stuff. No one wants to have a big laser printer in your house. And then the rest of it towards housing. And I wouldn't make it all affordable housing. I don't like the idea of ghettos. Like, I don't want people, when we do our developments, I don't want people to point to our development and say that's affordable housing. What I want people to say is, I want to live there and I can afford to live there no matter what my income bracket is. So we have, there's some product that's for people who are in the top quartile of income, people in the third quartile, second and first quartile. And I think it's that aim that we should be focusing on when reprofiling assets, is not to create ghettos, not to create stigma, but to actually rebuild our communities with a social impact lens on.
Amen to that. I see Juan nodding furiously, so I'll turn to you now, Juan.
Yes, I'm totally 100% or even 1,000% agree with Shamez on this point. Is not all the property are fit for the conversion for affordable housing, and in order to create the best social impact, it doesn't mean like you have to create all the property into the affordable housing. For example, the flagship kind of retail store, it doesn't have enough windows, the layout doesn't work for the housing, but potentially it could convert to the community center where people can gathering together and for the experience driven, or for example, dark kitchen or something like that for more like experience using or useful for the neighborhood. So in that scenario, it still creates significant social impact angle for the community wise. So in terms of social impact inputs, it doesn't necessarily come from affordable housing or housing only elements. You can from community investment, infrastructure investment. So it's a very diverse angle. And in terms of a conversion of the best use from the current property use, you can convert to housing, retail, or even from, for example, shopping center to a different type of shopping center or office in a disadvantaged location, but you can convert to affordable housing in terms of layout, it's more fits in the purpose. So I think there is a trend of changing of the use from the property given the COVID impact or people's habits is changing, but what's the best usage need to be considered properly.
Thank you. Thanks for that. Arnie, same question to you, and you are experimenting on the edge of, all these different new sort of conversions. What are your thoughts on converting some of this really depressed stock into housing?
Yeah, I think on principle, it makes a lot of sense, right? That we already have the assets in play. It has some residual value. Landlords may believe it has more value, but it's not one for us to debate. I think one of the challenges we have is, even from this panel discussion, it's a little bit too much finger in the air. We're kind of like, maybe we should put some social housing in there. Oh, maybe a dark kitchen makes sense. Or, we should do a community project. And I think it really comes back to one of our thesis of the whole purpose of our platform being built as an investment vehicle with, we just don't have enough information to make those informed decisions. The high street's been dying for a while, but the kind of things that seeded the death of that has been happening for 30 years, right? It's not over the last 10 years, suddenly high streets died. Indicators have been around for a long period of time. And I think that's one of the challenges we have in the industry is we don't look at the data available. We don't have enough real-time information to make good decisions. So there's too much of I would say, gut feel hypothesis. And what we should be doing, in my humble opinion, when it comes to these areas, is really looking at the information that we can collect both from public and private sources to understand, does it make sense for it to be repurposed into social housing? Does it make sense to have dark kitchens? Are we seeing spikes in delivery use and therefore we should increase dark kitchens, or there's a lack of opportunities for local entrepreneurs? So should there be a community project? I think there needs to be a little bit more kind of information and data behind it before we jump at these ideas. But I think in terms of the last 12 months, we've seen a definite spike in new ideas coming to market. So, we've seen, just to dive into one model that Juan touched on, which is dark kitchens, right? Completely unproven business model. I don't think any of them are profitable yet. I'm sure one or two investors globally might disagree with me on that, but broadly speaking, dark kitchens have not been seen to be profitable in any time period. But we've seen multitude of those businesses being launched and being rolled out across key cities and in brownfield sites. So I think we're seeing many more interesting ways of repurposing or reusing existing assets. But I think from a placemaking perspective or a city planning perspective or town planning perspective, I think we don't use enough data because actually we don't have that data at our fingertips, which then resulting in, decisions not being made often is the problem. It's not even bad decisions being made, just lack of decisions being made. And that then further causes issues. So, I'm somewhat segueing into your technology piece here by saying, that's what's really key for us as venture investors in prop tech is we as a asset class don't have enough information. We trade off historic information. Sometimes there are significant gaps in our information, or we're buying information from people who have a particular bias. So we're kind of being pushed in one direction or the other. It's all about understanding our assets better, in getting more information, and then we can make better decisions. And that can be from a financial return perspective, can be from an impact perspective, can be from clearly just making a better living environment for people.
So I see you prompted a point for Shamez, so Shamez will take that point, and then if you want to answer the other point you were going to add on, then I'm going to take another question from the audience.
Everything Arnie is saying is bringing tears to my eyes. I mean, God, I would love information, Arnie. Jeez, just a simple problem, commuting patterns. I just want to know how many people commute from Horsham into London every day at 9 a.m. Where do people go when they go to work if they live in Horsham? Really simple question. I can frame it. I can't answer it. Arnie can. Excellent. This has worked out well.
One of our investments can probably answer that question. If you ever look at slides, they'll give you commuting data. But anyway, I won't plug any of our companies.
Arnie notwithstanding, the only other place I could get that data was census data from 2011. Well, 2011 was a long time ago, right? So lack of data, I think, is really an interesting problem in real estate investing. I think there's so much better investment we could be doing if we had more data. And, that's why I love Man Group. Man is a data warehouse. We just suck in as much data as we can, satellite imagery, rainfall patterns, footfall in retail as a surrogate for consumption patterns. These are all the things that you need to have to make an informed decision. Historically, and I'm going to talk about my industry, there just hasn't been a lot of innovation in real estate. I mean, you look at productivity in the construction industry, it's been flat for 30 years. 30 years of no productivity growth. I mean, you can take a guy from a building site in 1875, bring him fast forward 145 years, and he'll know exactly what to do, right? I mean, this is the level of technological advancement we've made in 100 years on a building site. Not much. So I think to Arnie's point, things like MMC, they're finally starting to do it right. We've had a few companies do that. We're heavily investing into MMC. So we've got probably 700 homes in our pipeline around MMC. And, it's not cheaper. It costs exactly the same as a guy with a trowel and a shovel and a couple of bricks. But what it does do is it creates me, and this is to one of the questions on the panel, it helps me with my energy footprint, my carbon footprint. These homes are typically, I pulled up a couple of stats here, fabric performance is 20% better than building regs. Carbon emissions over the life cycle, so CO2 emissions due to heat loss are 15% reduced over a 60-year life cycle. Embedded carbon is down by 12.5%. So I think we can use technology to address, not as Arnie was saying, a social impact as well as an environmental impact at the same time. But we need to have innovation. We need to have innovation on housing tenures. We need to have innovation on data. We need to have innovation on manufacturing. And I think in the UK, we are now starting to see capital look at innovation. And the house builders are not the source for innovation in this country, right? They have an oligopoly. Why would an oligopolist want to innovate? It's the worst thing he could do, right? So I think we're at this really interesting point where impact capital can really drive forward by questioning these market failures, drive forward some really interesting change in the market.
So that's your marketing pitch, Arnie. Thanks to Shamez. Let me move off and take a question. Please give me a brief answer to this one. This is from Ben Tiplady. To what extent do you think the working from home culture will have a flattening effect on property prices in the UK and globally, with people no longer drawn to the big city to work and able to purchase further out? So and I guess implicit in the question is yes or no, is this a long-term trend And what sort of flattening do you think we'll see? Juan, I'll start with you.
I think the work from home culture just got speed up because of the COVID, and people start to use or like balance out their new way of working. And I think this is a more efficient way for people to work in a way as well. I wouldn't say like people will drop the office space forever, because people still need to gather in. Teamwork is more efficient by people work together. So I would expect this will change the landscape of the office, where is the most demanded, where is less demanded versus before, and the quality of the space as well, because now you may have more space before to make sure all the people working together, but now you may want to create more space for people gathering to do events and also rotation in terms of the desk. So how the layout of the workspace will, I believe, will change significantly, and where is the right place for people gathering is another question for after the COVID, I would say.
Great. I've got a question that's come up for you, Arnie, so I'll come to you in a second on that one. But Shamez, quick answer on that. Is there going to be a flattening? Is it long-term? How much?
I think it's going to depend on the type of real estate you're talking about. Housing, single-family housing in and around commuter towns around London, or wherever the center of employment is, to Juan's point, you're going to continue to have London, you're going to continue to have Cambridge, Bristol, etc. These cities where people work and have to come in, but they're going to come in twice a week or 3 times a week. And so they want nice places that have a garden, which have a nice working from home setup, et cetera, et cetera. I think those properties will go up in value. I think there's going to be some downward push on that 3-bedroom conversion in Fulham, where you lived on the 2nd and 3rd floor and you didn't have access to the garden, but you were close to all the great restaurants of Chelsea. You know, I think that asset is going to have, in the medium term, some downward pressure.
10%,
but I think
20%?
I think that'll lag because there's no forced selling. I just don't see, once the stamp duty stuff is gone, I don't see any long-term capital growth there relative to the other asset class. Let's call it a relative trade. Where I do think you're going to have downward pressure on prices, both in rental values and capital values, is that your family apartment in a tower block. If your tower block is 3-bedroom and 4-bedroom apartments in it, that's not a great thing to be holding right now, because there's just no bid for that, right? I think that 1-bedroom pied-à-terre for the executive who's got his nice house in the home counties and he's going to come in twice a week to his flat in London, and he wants something in the center, to your point, Rod, with great views, that's kind of got an interesting lifespan to it,
Thank you.
So I think it depends.
I'm going to have to ask you to be brief in answering this one. So Arnie, you can feel free to chime in on that last question, but also Masi Larisada has asked, small developers and managers, operating partners are finding it very hard to access capital, but there could be a real boom to adding scale on top of the large investors, big house builders. I think you have a portfolio company that addresses this small, or at least I think so. I was looking through your portfolio, but is there a way to solve the problem to have development take place in more entrepreneurial domains away from the large builders? Question for you.
I'll chime on the first one, and then I'll try my best to answer that question if I understood it right. But on the work from home principle and some of the things we're seeing, I think Shamez kind of seen it. There's going to be a bit of a lag there, and I think it's also the bigger factor here is how much longer are we going to be in this in and out lockdown, or the kind of harmonic effect of kind of in and out. The longer we have it, the more likely the work from home culture will start to stick, right? It takes a long time to form habits, and where we live, avoiding it sort of purely for work purposes, right? We have other connectivity, and sometimes it takes a long time to get out of a rental contract or to even buy or sell a house. So I think it's going to be quite dependent on the length of this COVID implications, and then also how long it takes you to actually uncouple yourself from a location. So I think there's going to be some interesting changes, but I think those two are very key factors. And we've seen some hyperbolic news press releases, and then the actual data on people moving has been far smaller. And then in terms of having more entrepreneurial developers accessing capital in order to unlock new opportunities in, should we say, less prime areas. I think to the question, what's PropTech going to do? It's going to be able to allow folks who have interesting product to access capital better. So your ability to raise capital is going to change over time. There isn't a incredible platform yet that allocates funding to real estate opportunities. I think Lend Invest is probably in the UK, they're probably the best known, but that's a lot of institutional product. Go on, Rod.
I was just going to say, so we have this thing about trying to start on time and end on time. So, I mean, I think your answer would have been very interesting, and I would have loved to hear it. But I mean, we could have gone on for another hour. I think, there were questions on healthcare, real estate. We didn't really talk about them. There's a lot more to talk about on the technology side. Normally at this stage, I'd also summarize, but I think in the interest of time, I'm not going to summarize. I think we had some really interesting points that were raised. I want to first of all thank Shamez Alibhai, Juan and Arnie Sriskandarajah for their participation, and thank you in the audience for joining us today. This is the 6th of our 7 of the series on impact investment funds. Future of Food is now up on the ClearlySo website, and probably the websites of our partners, Octopus and Paul Hastings as well. I also want to invite everybody to the next session, which is our last session of the year. It's a 2.5-hour session on economic recovery and how impact funds are going to be used for an economic recovery. And just to celebrate and also get the next year off to a good start, we have Nobel Prize winning economist Joseph Stiglitz as a keynote, and also the ex-Minister of Finance of the Netherlands, Jeroen Dijsselbloem, 2 very different points of view on how we can use impact funds to accelerate an economic recovery. That's on Wednesday, December the 16th. Please join us then. And in the meantime, let me thank again our panelists and everybody for participating. Thank you and have a really good afternoon. Bye.